Each and every week, we meet here live on Thursdays, and I know so many of you catch the replay as well to become enriched and to learn a little bit more. So I'm really excited about today's topic. It's one of those that even if I wasn't moderating the session, I would want to take notes on personally. The topic today is financing your business 101. All of us have these great ideas, things that we want to get done, things that we want to accomplish. And it's like, well, but how are we going to pay for it? How are we going to finance it? How are we going to continue to grow? And our expert today is Jose Puente, who has more than 40 years of experience in corporate finance, international trade finance, treasury management, and new business origination. So he's managed acquisitions, equity investments, and various forms of debt facilities. Also, just when it comes to geographic ranges, he has done it all. So US, Latin America, Asia, Europe, Africa, diverse experience too. So if you're thinking, well, I don't know if he's going to know about my business or be able to answer this question or that question. He's worked in consumer products, energy, capital goods, agricultural commodities, metals, mining. I can't think of anything else outside of that. So again, he's really covered it. If I can name drop on behalf of Jose a little bit, he's worked with some large public companies like PepsiCo, United Technologies, Commercial Metals, also several different private companies as well. Very important to note in this setting that he is also bilingual in English and Spanish. And if I can brag on one more topic, he's a Wharton MBA. On a personal note, he is a husband and a father to 3 daughters, one of whom is a SARE board member. So it just kind of brings it full circle with the family. The plan from here on out is to let Jose do his thing, give his presentation, and then again, as questions pop up, type them in the chat and I will ask them on the back end. Jose, take it away.
Very good. Thank you, Jenny. Thank you for that kind introduction. Appreciate that. Before I get started, I just want to, for purposes of full disclosure, I want to just say that there is no cookie cutter way or magic sauce solution to raising financing, securing financing. I want to say that just in case you were thinking that I was going to tell you how to go out and get a $10 million loan simply by just listening to me for 45 minutes. What I hope to do today is really just give you the fundamental building blocks that you need as you go down the journey and the path to securing financing. So with that disclaimer, let me turn on the screen here. I hope everybody can see that. So financing your business 101. What I want to cover today is basically things that you need to consider before you look for financing. You should really be prepared before you talk to any lender. You really need to be prepared and have your ducks lined up properly so that process becomes as efficient as it can be. I also want to take time out from this session to talk about working capital management. It's an area that is often overlooked. It's an area that could lead to finding cash flow that's in your business locked up. Area where you can work with your customers as well as your suppliers to provide you with some self-financing. And then I'd like to close the session with what I call the spectrum of financing alternatives, which is really a setup for the next session next week. And I'll comment on that a little later. Okay, what do you need to consider before you start the process? Well, the first thing you need to do is you need to register your business. You do this by filing with the Secretary of State. You file a certificate of formation. You declare yourself as the registered agent, or if you have a third party, but primarily it'll be yourself if it's a small business. You'll file an operating agreement. If you have employees, obviously this is where you get your EIN, your employer identification number. It's important to do this. This initial step of declaring and registering your business is the beginning of separating you as an individual and your business as a separate entity. So this is a very important step. When people ask you how long have you been in business, this is what they look to when they try to verify that information. They look at when did you file, when did you set up the business. It's a very important step going forward. A second important step, which are almost simultaneous to registering your business, is opening up a bank account, a business bank account. Again, It's a step in separating your personal from your business credit. It's a step in creating a bank rating. A bank rating is determined by the amount of money that flows through your business bank account. Obviously, the more money that flows through there, the more comfortable that a lender will be in terms of seeing that activity. And it's also establishing a bank account. It's not an easy thing to do. I mean, you go through a whole bank selection process. You should keep in mind, what are your needs? What are the needs of your business? What are the cash management needs of your business? What can the bank do for you? Um, and you should ask questions about what are the fees associated with the collections, the fees associated with using several of the features that the bank may offer. Obviously, the larger banks are more sophisticated and have a lot more to offer, but keep in mind that a larger bank is not as likely to deal on the credit side with you as would be a smaller bank who maybe would have different priorities. So you need to really get comfortable. You need to get really comfortable with the bank. The bank statements also serve as a verification, for tax purposes and a verification for financial reporting. And on that note, in terms of taxes, get your tax returns in order. Be prepared. Be prepared to provide tax returns. You are going to be asked to present tax returns in the verification process of the loan. When you obtain a loan, it's important that you have these documents readily available and organized. It's important that your filings, if you have employees, obviously you have 941 filings that are up to date. Your quarterly tax filings are there. This is all very important during the verification process. Um, Record keeping. Record keeping is extremely important, and you should really think this through as you build your business. As you start off with this, as you start off in the back of your garage, back of your car, you really ought to start from the very beginning, selecting tools that help you with the record keeping. We are fortunate today in the world of software that we live in that there are many tools available. They're not expensive. You don't need to have a bookkeeper anymore. You can more or less do it yourself with the help of the software. What the software also helps you in terms of establishing controls. As you get to different forms of financing, receivable financing, inventory financing, the lender is going to look to your accounting system, to your controls that are in place, to give them the comfort that you're properly managing your receivables, you're properly managing your inventory. So software and financial reporting is extremely important it's a truly important building block as you approach a lender, and giving them comfort that your record keeping is up to date. Now, obviously, if you're a larger business, you get to the point of having audited financial statements. But as you start your business, in the start, you may not have audited financial statements. But if you have the proper software, you can give someone comfort that the numbers are what they are. The last point here, and what you need to consider, is really the business plan. Now you've probably heard of this from a number of different people. You need to have a business plan for your business. You need to know your numbers. You need to know what your pricing is, what your competitors are pricing. You need to know your margins, your cost structure. You need to know your market. You need to be able to articulate this in a document, because you're not going to only be able to tell people about it, but you will have to provide this information in writing to the prospective lender. That business plan should lay out your strategy. That business plan should think through what your future capital requirements are. One of the major reasons why businesses fail is because they run out of capital. So you need to think forward in terms of what your future capital requirements are to fund your growth. And most important also is you can use this business plan to describe to people why you need the funding. What is the use of the funding, and how it is critical to the business, and how it will add to the success of your business. So that in a nutshell is really what you need to consider before you really start the process. Now, what are lenders going to be looking at? They're going to be looking at your lendable strengths, and these are referred to as the C's of credit. So the first C of credit is your credit history. Um, if you have a business that's been established, you'll probably have a Dun and Bradstreet, a credit report. There are several credit agencies that offer this. You should subscribe to those. You should get on those credit reports. If you don't have a Dun and Bradstreet, then obviously lenders are going to be relying on your FICO score, on your personal credit. Again, going back to an earlier slide where you want to start developing the difference. You want to start differentiating your personal from your business. And it's important to do this in such a way where lenders feel comfortable that they are looking at your business credit as a standalone entity. Capacity for debt. Again, your accounting system, your financials will show lenders your ability to service the debt, your ability to repay back the debt, to pay the interest. And typically they're looking at a debt coverage ratio, which is referred to, that's what they look at. And that's typically a factor of 1.25 to 1.5 times the amount of debt service that you have on a periodic basis. So you need to have cash flow. You need to have a cash flow statement that generates this cash flow that you then compare to your debt service, and you're able to show the lender that you have the capacity to carry the debt. Collateral, your balance sheet. Lenders will be looking at your balance sheet, and they will be looking for sources of security. They will be looking for anything that they can put a lien on to secure themselves. In the event you don't repay, they will have recourse to the security. So that's an important thing to have in mind. Think that through before you approach a lender. What is it that I have in my business that I can provide as security to the bank? And security doesn't necessarily have to be equipment. It doesn't necessarily have to be commercial real estate. It can be your receivables, as we will see in a second when I speak about working capital. It can be your receivables, your inventory. These are assets that you have as a business that are available to provide security to the lender. Capital. It's virtually impossible to finance a business without having equity in the business. There are very few lenders out there that are going to allow you finance your business with 100% debt. What you're showing a lender when you show them that you have skin in the game, that you have equity in the game, you're giving them a comfort that there is a level there. There is a floor level of security that they have in the business. So it's important that you think through the capital structure. And when I say capital structure, the capital structure is made up of debt and equity. You need to start building the equity base. Once you have the equity base built up, then obviously you can add to that the debt base that you require to finance the business. Conditions. You need to think through the conditions. You're going to ask a lender for capital. You need to think through what are the loan proceeds going to be used for. This will also impact the perception of risk associated with the loan that is being given to you. If you're telling the lender the loan is going to be used to buy a specific piece of equipment or a specific asset that's going to be used in the production of a product that you're going to sell, that gives the lender a lot more comfort than if you were to say, gee, I want you to lend me $1 million purely for working capital purposes. Lender's going to scrutinize the deal more closely if it's working capital, general corporate purposes, versus if they're going to be lending for a specific purpose like an asset acquisition. So again, your lendable strengths, these are the C's of credit, the famous 3 C's of credit. I've added 2 more: capital and conditions. These are things that you need to consider as you approach a lender. Now let's talk about the loan application process. First of all, the loan application process and the risk appetite of lenders, every lender has a different risk appetite. Every lender probably has a different process for looking at a loan. And you need to appreciate this as you speak to lenders. You have the large national commercial banks that have certain policies in place that you need to understand. In other words, there are certain large banks that will not lend to a business unless they have audited financial statements. There are certain banks that will not lend to a business unless they have X amount of assets, X amount of sales. So you need to sort of tailor your approach. You may be better off approaching the regional community banks, which may be more friendly to a small business as opposed to a large, as opposed to the large banks, which may not be as friendly to a small business. Then you have a whole host of different types of lenders that you don't see on the street. You have asset-backed lenders. These are investment funds that basically are buying loans from people who originate loans. So when you click on the internet, for example, and someone says, "Gee, I can get you $10,000 to $2 million in 24 hours," what those folks are, they're brokers, and those brokers are then going to the asset-based lenders, to the non-bank lending institutions like insurance companies, to the small business investment companies who basically are venture capitalists that take their capital and lever it with debt, or private debt funds. Um, Again, important to understand that not all lenders are the same. Not all lenders have the same risk appetite. You really need to shop around. You really need to have a clear understanding of what the financial institution that you're working with is prepared to do. This goes back to opening up the bank account. When you open up the bank account, you need to keep this in mind. You say, is this bank going to be a potential lender? Am I going to be able to expand the relationship with this bank beyond just cash management, beyond just having a checking account and a savings account? Am I going to, and that's very important to keep that in mind as you move forward in the process. Process starts with a verification credit underwriting. And by the way, it's important to understand, you walk into the bank, your local bank, and there's a person sitting in the office, and you explain to them that you need a loan. That person is not going to be the person within the financial institution that's going to be managing your loan process. Chances are that is a relationship manager that sits at the branch, for example, and they obviously will then be in contact with somebody internally who is the lending officer. That lending officer could be someone who's lending to the retail industry, someone who could be lending to a different segment of the business, and that's really what you need to get to. You need to go beyond that relationship banker that sits in the branch to understanding who is the lending officer. Start that dialogue with the lending officer, and you're going to find that that's where the requests are coming from. The requests are coming from that lending arm of the bank that is going through a verification process, or is going through what we call a credit underwriting process. And this is a back and forth. This is something that doesn't take place in a day. No matter how well you package the information that we've touched upon, no matter how well you package your financials, how well you package your tax returns, you're always going to get a series of questions that are going to be follow-up questions. And it's going to be a back and forth. It could take weeks. It could take a month for a bank or a lender to go through an underwriting credit process. That underwriting credit process will then lead to what we call a term sheet, which are effectively, once the bank understands your business, understands what you're going to be using the money for, they will then put terms and conditions associated with the financing in what we call a term sheet. And it will spell out in black and white, this is what the money is going to cost you. This is how the money is going to be advanced to you. These are the requirements that you're going to have as a result of taking the loan. These are the covenants. These are the restrictions, as I referred to earlier, the covenants that are going to be in place. So you'll understand exactly how the loan is going to be managed based on the terms and conditions that are in the term sheet. Term sheet, you sign the term sheet. In other words, the bank is not going to go forward with a final credit approval, although most banks, most lenders will have a very good feeling. The lending officer will have a very good feeling that the deal can be approved on the basis of the credit underwriting exercise and on the basis of getting the term sheet. There is an internal approval that takes place within the bank, within the lender organization, before a term sheet can be issued. And a term sheet is a commitment, but it's a commitment. If you read the conditions of that commitment, it's a commitment subject to final credit approval. So there may be additional questions coming, but what they want to do with the term sheet is they want you to sign the term sheet. They want to get your agreement on the terms and conditions before they move through to what is called final credit approval. A final credit approval is generated. Final credit approval tends to be a very quick process. Lending institutions meet multiple times a week. You should not be waiting for a credit approval for weeks. It should happen fairly soon, the moment you sign the term sheet. Once the credit approval takes place, then you go into documentation. And again, depending on the size of the loan, you will either, the bank obviously will be drafting the documentation. Some banks have their own internal documentation, their own internal legal department that they use. But if you're looking at something significant, the bank will most likely have an outside legal firm that represents the bank, that will prepare the documentation, that will go through all of the requirements necessary to close the loan. Once the documentation is completed, you then have the funding of the loan. And again, the funding of the loan will be described in the term sheet in terms of how the bank is going to disperse those funds to you. So that's effectively the loan process. It's a back and forth, and you need to be cognizant of the fact that not every bank does it the same way, that certain banks will have different levels of appetite. You really need to shop this around. The same way that you shop establishing that bank account relationship, you should at the same time keep an open mind in terms of what are you going to need in terms of lending down the road, and to sort of align yourself with the bank. The more that the bank knows who you are by having a bank account there, by having the information very clearly laid out, your business plan very clearly laid out, the easier this process becomes. Okay, now let's move on to working capital. I'm kind of deviating a little bit here from what is financing and what is the loan process to an area called working capital management. It's an area that I find that many companies, including some of the larger companies, they don't pay much attention to it, but it's an area that could provide some very fruitful financial benefits if you take some proactive approach to the management of it. So here's a balance sheet, just to make sure we're all on the same page in terms of what we're talking about. Here's your typical balance sheet. On the asset side of the balance sheet, you have cash, receivables, and inventory, which make up what we call total current assets. And then you have underneath total current assets, you have fixed assets. The sum of the two is effectively your total assets. On the liability and equity side of the balance sheet, your current liabilities are largely made up of your trade payables. That is the amounts that you owe to suppliers. You have taxes. You could have taxes in there if you pay quarterly taxes. And you could also have a current of your bank, a portion of your bank debt, which is known as the current portion of your debt, which could also be included in current liabilities. If your bank debt extends beyond 1 year, that portion of debt that is beyond 1 year is typically below current assets. And then obviously you have the equity on the equity on the bottom half of the liabilities there. Bottom line, as you look at this, the right-hand side of the balance sheet is financing the assets which are on the left-hand side of the balance sheet. So in terms of working capital, it's current assets less current liabilities is what is referred to as working capital. Now, working capital has another name. And working capital in a dynamic sense is called the cash conversion cycle. Now, the cash conversion cycle is very simple. You start out by buying something. You buy either raw materials, you buy inventory that you buy something you may want to resell. You buy that through a supplier credit. So the supplier gives you a certain amount of days to pay for that inventory. That inventory then gets sold to your customer. That creates what is a trade receivable. That trade receivable then gets collected, and you start the cycle all over again. You take the cash. Cash then goes to buy more inventory. Trade payables are created when you buy more inventory, and so forth and so on. And this is what we call the cash conversion cycle. Each steps along the line can be measured, and they're measured in days. So you'll have an inventory, you'll have your day sales in inventory. What that means is, how many days of sales do you have in inventory? I mean, if you're reselling something, you shouldn't be having inventory that's been there for a year. You should, your inventory should be a lot more reasonable. Your inventory turnover should be a lot more reasonable. Obviously, if you're importing product from China, for example, and it takes 6 months for that product to come in from China before you receive it in your warehouse in the United States, you could easily have inventory in there you could have an inventory turn that exceeds maybe 120 days, 180 days. So that's how we measure inventory turn, how quickly that inventory is sold after you receive it, after you pay for it. Trade receivables are the same way. It's days sales outstanding. In other words, how many days of sales do you have in your trade receivables? How many days of sales are there that you have yet to collect those sales from your customers? And that's another metric that is commonly looked at. Cash is cash. And then if you go onto the liability side of the balance sheet, you have days payable outstanding. It's another concept. How quickly do you pay how quickly do you pay your suppliers? Um, in this case, when you're trying to generate cash, paying your suppliers later rather than sooner, paying them over a longer period of time is good. So there's an inverse relationship between working capital. In other words, the more working capital you have is inversely related to the profitability of your business. You should really have less working capital. Less working capital improves your profitability, reduces your capital requirements. So your strategy should be, when you're looking at the cash conversion cycle, your strategy should be to increase your turnover, which means what? It means lower days of inventory, lower days of sales outstanding receivables, and increased days of payables. If you think about that dynamic, you should be able to improve, take money that you have in working capital, squeeze that working capital where you basically take out cash. That will in turn reduce your capital requirements. It's sort of like it's a self-financing mode. You reduce your capital requirements, and at the end of the day, you improve your profitability. So this cash conversion cycle is very important, especially for businesses that are in early stage, where they don't have access to the financial markets, where capital in the financial markets is extremely expensive. This is a way where you can work with your customers, you can work with your suppliers to manage these metrics. So managing the conversion cycle, you start out with inventory management. I mean, what can you do? First of all, you have to have visibility over your inventory. You have to keep track of your inventory. Again, goes back to what I said earlier about having a robust financial system in place, a module that specifically looks at the level of inventory you're carrying, how quickly that inventory is turning over. So just by being focused on inventory should help your situation, should help you reduce the amount of inventory you have. I mentioned earlier, if you're buying product in China, you're going to have to pay for it when it leaves China. It's going to be sitting on a boat. It's going to be in transit, as we call it, for a long period of time. So to the extent that you can find suppliers that are closer to home, that are closer to your warehouse, you're going to effectively improve your days outstanding in inventory. You also should be talking to your suppliers about the just-in-time. Very popular concept many years ago, was introduced. It's now common sense. It's common sense in business to manage your inventory on a just-in-time basis. This is not going to be a strange concept to your suppliers, and it's something you should look at. How quickly can you get that inventory from the supplier to your customer? In many cases, without even having to touch that inventory, having your supplier, to the extent you're a reseller, having your supplier provide that inventory directly to your customer. Therefore, you're not even having to record that inventory on your books, or at least have what we call a flash recording of it. Comes in, comes out simultaneously. That's important. You may be able to explore with your supplier a consignment inventory. A consignment inventory is where the supplier gives you access to that inventory in your warehouse, and you don't pay for it until it's actually sold to your end customer. That avoids the capital requirement of buying inventory. Again, depending on your relationship with your supplier, depending on how important you are to your supplier will look for the opportunity to make sure that you always have their inventory on hand, and you're always selling their inventory before their competitor's inventory is sold. So these are concepts that if you keep in mind and keep an open mind as you think through your business, not all of these will be applicable to all businesses. Some businesses lend themselves more to these types of management techniques than other businesses. But again, it's something to keep in mind. Receivables management. Receivables management, again, it's kind of common sense, but it's sort of maintaining an efficient collections process. You'd be surprised how, and this happens more in large businesses than it does in smaller businesses. You'd be surprised how many times customers do not pay invoices because the invoice is in error, or customers do not pay because there's a dispute over a delivery. And this goes on this goes on for a period of time where you're waiting to get paid and the customer's not paying you, and they're not paying you because they have good reason not to pay you. So you need to have a process where you're constantly following up. If that payment is not made by the payment date, you need to have a proactive process in place. You need to have a dispute management process in place with your customers. You need to make sure that your invoicing is being properly done. You need to make sure that the invoice is going to the right place in your customer's organization, that it's basically getting paid on time. You cannot be silent on this. This is extremely important to maintain that cash flow coming in as it should come in. Now you start, the next thing you can think about is sort of talking to your customers about maybe offering them a prompt payment, maybe offering them a discount. Again, run the numbers. Capital can be extremely expensive, especially if you're a smaller company. Capital can be extremely expensive. You may be better off offering your customer a discount to accelerate the receipt of the cash, as opposed to waiting 60, 90, 120 days to get paid by your customer. And again, this is more of a discussion, more of a collaboration with your customer to say, hey, can you pay me sooner? You may even want to explore the possibility of receiving an advance payment from your customer. Certain businesses where you're putting things together where you're making pieces that are order pieces, that you're buying raw materials to put something together for your customer, you can argue that you need an advance payment to cover some of your cash outlays that are required to build the product, or to pay for the services that you're providing. So again, you need to be proactive about this and think about managing your receivables in a very proactive way that minimizes the amount of time that receivable remains outstanding, so that you have cash coming in your hands as quickly as possible. Payables management is an area that has become extremely popular in large companies and in general, and then that is deferred payment terms. It's not unusual for suppliers to be asked by their customers for deferred payment terms. And what large suppliers, especially if you're dealing with a large supplier, if you're dealing with a large supplier that has basically access to credit, they can certainly turn around and offer you a deferred payment program, 180 days, 120 days. And instead of you having to pay your interest rate on it, which may be higher than their interest cost, they could pass on their interest costs to you in that deferred payment period. This is extremely popular. I've seen it. I was in the coffee business. We would be selling green coffee to people like Starbucks, to people like Nespresso, Swiss, and they would want basically deferred payment terms, and they knew well that we could provide those payment terms at very attractive interest rates to them. So this is something that you should consider. Explore supplier financing programs similar to deferred payment terms, but financing programs are largely maybe more so tailored to when you're acquiring a piece of equipment. You can ask for supplier terms that could be more attractive to you than if you were to go out and have to finance that piece of equipment, that acquisition on your own. In summary, when you're dealing with working capital and you're dealing with inventory, receivables, and payables management, you need to change your mindset from one of negotiation to one of collaboration. it may be in your best interest to offer a discount to your customer. Um, you want to make your customer feel good. You want to make, you want to provide value to your customer to have them maybe pay you promptly. Um, Likewise, you want to sit down with your suppliers. You want them to understand your business. You want them to understand the conversion cycle in your business, how long it takes for you to collect your receivables. And hopefully they will be able to mirror the time that it takes you to collect a receivable with payment terms that you have with them. So it turns out to be more of a collaboration in the negotiation. So many times, you sit there and you're focused on the 30 days, and you're focused on paying extended terms. But if you have a conversation with your customers and your suppliers, it becomes a much easier thing to do, and you'll find out that there may be some hidden gems in those conversations. Okay. Um, Let me get here. Let me see. Where are we? Where are we, Jenny? How are we doing?
You're doing amazing. We're at 3:37, so we're rolling right along.
Okay. Let me touch on this slide here, and I could speak to this for quite a while, but let me just touch upon this because this is very important to understand as you approach the market. So you're either an early stage business, i.e. a small business just getting started, or you're a matured early stage business or a matured business, which is the other extreme of the spectrum. So on the left-hand side of the spectrum is your early stage. On the right-hand side is a more mature business. And obviously your access to lenders is much different whether you're early stage or whether you're a mature business. Your first, as we go back to skin in the game, what you need to start off with is you need to start off with equity. You need to find an equity investor. This is typically how business get financed early on in the process. So you obviously have your sweat equity. Um, there's no way to really quantify that on the balance. I mean, there's no way to capitalize your sweat equity. That's what capitalization is, how you put assets and liabilities on your balance sheet. You can't do that, but obviously you need to be able to tell that story. You need to be able to tell lenders, yeah, I've been involved with this. I haven't taken a salary, et cetera, et cetera. That is basically sweat equity. Then you have your money, and you have your capital that gets recorded as equity cash coming into the business. And that sits on your balance sheet as your equity in the business. And then you have what I call other people's money. And there is a whole host of other people's money. Go on and on, identifying different sources of other people's money. You may have heard of crowdfunding. You may have heard of venture capital. There's all sorts of different ways to get other people's money. There's different ways to get other people's money by just looking at the working capital. You can get the supplier to give you their money to allow you to finance your business. But that's sort of the equity side of it. Then we come to an area, as your business matures, as you go from sort of the concept stage to the proof of concept, and you're moving along, you have a whole area called grants, which I call grants. These are largely economic development grants. This is actually money. Most of these grants are basically channeled through what I call the nonprofit channel. I consider the SBA to be in this category. In order for you to be eligible for an SBA loan, you literally have to be rejected by a bank. So then the bank takes the guarantee of the U.S. government, i.e. the SBA, and on the basis of that guarantee lends you money. But before you can approach the SBA for their support, you need to literally go through the private sector, and you need to somehow be rejected. And obviously then your bank will point out that if you had a guarantor like in the SBA, they could maybe facilitate the financing for you. So there's this middle ground as you move from pure equity to grants. And then you get into the debt category. And the first category of debt that I have here is what I call transactional debt, transactional bank debt. And these are alternatives, financing alternatives that are literally using the assets that you have in the business. Concepts like invoice financing, receivable factoring, purchase order financing, inventory financing. In other words, the bank or the lender is providing you capital on the basis of an invoice that you have generated, a sale that you have made to a customer. They're providing you finances on the basis of you having a receivable, an IOU from a customer. They're providing you financing, purchase order financing is they're providing you financing to go out and to buy that product that you're then later going to resell. And what I hope to do in the next session is go through these different areas, because I think that for early stage companies, for companies that are younger, these are the areas of financing that I think are going to be most fruitful to you. The last area, which is really difficult financing to obtain, it takes a more established business, is what I would call bank debt. And bank debt comes in many different forms. There's asset-backed lending, which is called ABLs, asset-backed lending. There are revolving lines of credit. There's term debt. When you're talking about bank debt, you're talking about where the bank maybe, even though there's a reason why they're lending you the money, they have less control over the funds than they would, for example, in the transactional debt. In transactional debt, the lender is actually following the invoice. The lender is actually following the receivable. They're following the purchase order that you're buying the product from. They're following the sale of your product to your customer. So as you can see that there's more control, there's more area for the lender, there's more opportunity for the lender to have visibility to what you're using the funds for. When you move into the last category of bank debt, the lender is losing visibility, therefore they are requiring a much higher credit quality. They're requiring a much more mature company that has proven processes in place, proven controls in place, that gives them the assurance that the repayment is less of a risk than with a younger company. So what I hope to do next week is kind of get involved with the transactional bank debt. I hope you tune in. I would like to suggest that if you want me to discuss anything specific next week, it's more specific than say, I plan to cover invoice financing, receivable factoring, purchase order financing. If you have something else that you want me to cover, please feel free to contact me. Here I'm listing here my phone number, my email, my LinkedIn account. Please feel free to suggest what you want me to cover. The subject of financing is very broad. I hope that what I've pointed out to you in terms of the fundamental building blocks, the criteria of the lender, the opportunity that you have in working capital, I hope that that's been helpful to you. And as I said, in the next session that we have next week, I will be getting into more specifically the areas of transactional lending that I think could be very fruitful to a smaller business. So with that said, Jenny,
Awesome.
I don't know whether I'm over, under, or you tell me.
Literally at 3:45 on the dot. I mean, you are a man who works with precision. I said, how long do you think this is? He said, 45 minutes, give or take, 45 minutes on the dot, which still gives us a solid 15-minute chunk for Q&A, which is incredible. You all also, it was so generous of him to leave his information. So ask your questions now. I know some of you have sent them to me, but jot down that information before it disappears in the chat there. So I'll start off with this. First of all, get the gears going, everybody who's watching, in terms of those specific finance questions. If there's a certain type that you're looking for, he can cater that. He's got a week before the next session. So be thinking of that and post it in the chat if there's something specific you want him to speak on next week. But I'll kick things off with this question from somebody who is brand new, doesn't have a lot of lending history. He's saying, what are some of the good tactics or techniques that have worked for newcomers in getting a loan? Basically, how to sell yourself when you don't have a lot of experience and you don't have a banking relationship? I was hearing you say a lot about, you want them to know you when you walk in and that sort of thing. What if it's like you're coming in off the street, you've never been to a bank before, or a bank that does this type of lending before and you don't have any connections?
Well, those first two slides that I covered, the fundamentals are very important. Uh, they're generic fundamentals that any lender is going to want to see. They're going to want to see that you're a real company. They're going to want to, they're going to want to see some verification that you have economic activity in your business, profitable economic activity. Um, there's no way around that. There's no way around that. So be prepared. Number one, I would suggest that you be prepared with that type of information, with the business plan, because that's what you're going to get asked. And be prepared to articulate what your business does. Identify, then that's number one. Number two is when you walk into your local branch, if you're a small business, you're going to start with your local community bank, the smaller banks. Understand that the person that you're meeting is a relationship person that sits in the branch. Um, you need to get to someone who is really in a position to really listen to what your business is, to make an initial assessment as to whether your business is bankable or not. So talking to the right person at the bank, getting to the right person who can give you an indication as to whether it's going to work or not is also very important. Um, Obviously, when you open up that bank account, when you start your business and you open up that bank account, you need to be keeping in mind that someday you're going to be asking that bank or that lender for credit. So obviously, developing that relationship early on in the process is very important. You can go on the internet and you can click, okay, I need financing, and there's three questions that you're going to see on the internet. How long have you been in business? What are your monthly sales? And what's your FICO score? I mean, that's common. That's what I was talking about in the beginning of the presentation. You should be able to, you should be able to answer those questions in a much more professional way. But how long have you been in business? Well, I've been in business. You have to be in business at a minimum of 2-3 years before you can really go out maybe and ask someone for money, unless you're asking for funding in the grant category that I pointed out at the end. Grants obviously are a form of subsidized financing, but if you're looking for third-party financing, you need to really have your ducks lined up, and you need to be really talking to the right people at the bank.
Okay, yeah, it sounds like you've got to just get started. Like you've got to just get started and be reliable and be on top of things, right?
You gotta get started on the right foot. You could spend a lot of time. You can waste a lot of time developing your business and dealing with your personal bank account to fund your business, or you know not registering your business. That's wasted time. You need to really put those fundamentals in place so that when you approach a lender, you have that behind you and you can build upon that.
Okay, and so that you're showing it's again, it's part of that skin in the game that you spent the time to do that and to do things properly, and you're not just doing a money grab for something that's going to be really disorganized.
Correct.
The thing that you pointed out that I think was so impactful and so important for everybody to hear is all the questioning coming back and forth from the bank, because I think that if somebody wasn't expecting that and all of a sudden they started getting all these questions from the bank, they're like, forget it. That nobody wants to lend me money, and so that's a very normal experience, right?
That's extremely a normal experience. I mean, this is not, if someone is advertising that they can get your money in a day or 24 hours, I mean, that's going to be number one, very expensive money. And you don't really know the answer to that because they're going to ask the questions. So you're gonna constantly go through a back and forth. And that was the most labor part of the process that you have to keep in mind. It takes time. If you're an entrepreneur and you're managing a business and you don't have a treasurer like a large companies have people that are in the treasury department whose job it is to arrange financing and to manage bank relationships and to effectively answer these types of questions on an ongoing basis. Because even after getting the loan, you're going to have to report back to your bank. You're going to have to take the time to keep them abreast of what's going on in your business and what's going on with the repayment status of their loan. So yeah, you need to get accustomed with that. And you need to prepare yourself. You need to have the information readily available in a very efficient manner so that you don't spin your wheels and you don't get frustrated by the process, the back and forth that goes on.
Yeah, sometimes the aspect of being mentally prepared for something is just like what will keep you in it, right? Knowing that, okay, this is normal. I knew they were going to ask me this and I'm ready, or I'll find the information, and just sort of staying positive throughout that. Getting a question from somebody, and this may be more of a topic for next week, or this may not be in the arena that you do at all. You tell me. Do you know how easy loans work from the SBA? Are you familiar with that?
I'm 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 not an SBA expert, and
Okay.
in fact, I'm going to be hosting a session at the national conference, and I'm thinking about bringing in someone from the SBA who can get to detailed who can ask you can ask detailed questions of someone who is familiar with micro lending. I mean, I'm aware of conceptually how things work, but I'm hoping that during the national conference we can have a more detailed discussion, and I can introduce a couple people that could be helpful in that regard. But bottom line, SBA, as I said, and I think I mentioned during the presentation, is you don't apply to the SBA directly for a loan. You typically approach the SBA through your local bank. Your local bank will see the opportunity that you're not bankable, i.e., you're not bankable in an independent sense, but you have certain characteristics, certain things going on in your business that can make your business, eligible for an SBA guarantee. An SBA is not a loan. An SBA is a guarantee. And then there are different types of loans within the SBA. There's a 7A loan, there's a 504 loan. 504 loans are for real estate. 7A loans are more for basically working capital purposes in your business, equipment and that type of thing. But you work the process through a lender. So you go through the same thing. You have your bank account set up at a bank. When you set up the bank account, if you think you're going to go through the SBA process, you should ask the bank, do you guys handle SBA loans? Do you facilitate SBA loans? And that's how you go about getting an SBA loan.
Okay, that's great to know, because I actually was under the impression that people were going straight to the SBA too. So I'm glad that you clarified that. Jose came in here and said, I don't know anything about SBA. And then he just gave us a bunch of info. So that was actually very helpful. And I will also say to the person who asked the question, we have done first of all, we have that to look forward to, that session that's upcoming at the conference. But also we have done one of these 60-minute sessions on SBA loans. It's going to be on Sarah National's YouTube channel. You'll scroll back. It's been within the last 3 months. I wish I had an exact date, but it's been within the last 3 months. You won't have to look back very far. You'll see it says like SBA small loans and starter loans, that sort of thing, and you'll be able to go in there and learn about it. So thank you for reminding me of that.
I do want to say one thing, Jenny.
Yes.
Don't think that an SBA loan is sort of a slam dunk. Don't think that it's easy to do. The verification and the underwriting process is just as rigorous as if you were to go to the private sector, to a private bank or commercial bank or community bank. The underwriting, the bank that is funding the loan, the bank that is providing you the loan, that the SBA is guaranteeing, is obligated to do the same verification, the same underwriting due diligence that they would do if they were lending the money from their own treasury department. So keep that in mind. It's not a freebie. It doesn't make things easier. It's just as difficult.
I'm glad that you brought that up. I do think that there is an aura around it that makes it feel more of like that freebie type word. So I'm glad that you brought that up. Now, listen, let's give a scenario here. Somebody who has excellent personal credit. They've been great with their finances. They've paid off their personal loans. They have zero business experience, but they have a business plan. What's their first step when it comes to getting their financing in order? Is there a certain type of bank they should start with?
Well, if they have an ongoing business, they should have a bank account with a commercial with a bank and that's where you should start. You're giving the bank business, you're providing the bank with business, and there should be some reciprocity, as we say. In other words, you're giving them your banking business. I'm sure you're paying fees for certain things you're doing with the bank, and they should in turn listen to your proposal, and consider making you a customer, a credit customer. They should get a certain level of comfort. The fact that you've been dealing with them, they should get a level of comfort that you have some substance behind your business, and that you have been paying your bills on time, et cetera, et cetera. That's very important. I mean, that's going to make it easier. Obviously, when you go out and look for financing, you have that bank, right? You have the bank that you've been sort of dealing with on your bank accounts, but then you also have to go around and explore what the market is. You have to go talk to other lenders to get a feeling for you have to shop it around. You have to shop it around and get a feeling with other banks what they're prepared to do. And you use that shopping around in a negotiation with your existing bank. You use that as leverage in terms of trying to get them interested in developing you as a customer. Otherwise, you're going to take your business to the other bank that's prepared to lend you the money. That's just basic common sense, and just that works. That works better than anything else. Is when you say to them, well, Bank XYZ down the street is prepared to lend me money, and you'll get people's attention by doing that.
I think that that's a perfect place to stop. And you're right. It's like some of this is common sense. It's just the way that you would be a human in the world is the way that you would also exist as a good sort of business citizen, is, keeping your promises and then shopping around. Jose, thank you. It's been an absolute pleasure to chat with you. And
Okay.
we're only halfway done because we get you next week as well.
We'll see you next week. And if anybody has any suggestions about what they want me to cover, I'm going to I'm pre-announcing that I plan to cover those parts of the spectrum that are basically the transactional banking alternatives.
Transactional
Very good.
banking.
Thank you, everybody. Thank you for listening, and look forward to seeing you next week.
I look forward to it too, Jose. It's going to be another great session. So here's the deal. If you guys know somebody gosh, a colleague, a friend that's in business that might benefit from this session, the replay will be up by Wednesday. So they'll be able to watch that replay Wednesday, or you can watch the replay if there were tidbits you didn't get or you wanted to take notes on. And then he'll be back with us on Thursday. So it's, the same situation here, Financing Your Business 102. He's giving us the crash course here, and then we're all able to benefit from it, which is incredible. And we alluded to SARE National's 59th annual conference, Creating Gateways to Economic Equity, and that's going to be May 10th this year in Plano, Texas, right here in North Texas. So I look forward to seeing all of you there. Also, if you're looking for the replay of this session or previous sessions, they're all on the YouTube channel that is linked in the chat. And we will see you back here next week, same time, same place. Bye, everybody.